Hello everyone, and welcome back to the Wealthnetic channel. Have you ever looked at the stock market and just felt completely overwhelmed? Or maybe you've heard the name Warren Buffett and wondered, how does he do it? How does he consistently make such smart investment decisions? Well, you're not alone. For decades, people have tried to crack the code of the Oracle of Omaha. Today, we're going to dive deep into a book that does just that. It's called The Warren Buffett Way by Robert Hagstrom. This isn't just another finance book. It's a roadmap that breaks down Buffett's investment philosophy into principles that you and I can actually understand and apply. So, if you're ready to stop gambling with your money and start investing with intelligence and confidence, you've come to the right place. Let's get started. At the heart of Buffett's strategy are a few core tenets that might surprise you with their simplicity. Hagstrom boils them down beautifully. The first, and arguably the most important, is to think like a business owner, not a stock trader. What does that mean? It means when you buy a stock, you're not just buying a ticker symbol that goes up and down. You are buying a small piece of an actual business. Buffett doesn't ask, will this stock go up next week? He asks, is this a good business that I would want to own entirely for the next 10 years? This simple shift in mindset changes everything. It forces you to look at the company's long-term health, its management, and its competitive position, rather than getting caught up in short-term market noise. The second key idea is the concept of the circle of competence. Buffett, famously, says, I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. He only invests in businesses he thoroughly understands. If he won't explain how a company makes money and what its competitive advantages are in a few simple sentences, he stays away. This is incredibly powerful. You don't need to be an expert in every industry. In fact, you're better off becoming an expert in just a few. Are you a doctor? Maybe you have an edge in understanding healthcare companies. Do you work in tech? You probably get software business models better than most. Stick to what you know. This discipline prevents you from making costly mistakes based on hype or a hot tip from a free end. The third principle is the margin of safety. This is your ultimate protection against bad luck or errors in judgment. The idea, which Buffett learned from his mentor Benjamin Graham, is to buy a business for significantly less than its intrinsic value. What's intrinsic value? Think of it as the true worth of a company based on its future cash flows. If you calculate that a company is worth $100 per share, you don't buy it at $99. You wait until you can buy it for, say, $60 or $70. That difference, that $30 or $40 cushion, is your margin of safety. And finally, the fourth major concept is to be patient and wait for the fat pitch. Legendary baseball player Ted Williams was famous for waiting for the perfect pitch in his sweet spot before swinging. Buffett applies the same logic to investing. The stock market is a knockout strike game. You don't have to swing at every opportunity that comes your way. In fact, you can let thousands of pitches or investment ideas go by without penalty. You can simply wait for that one perfect opportunity, that great business selling at a ridiculously cheap price. When it comes, and you recognize it, because it's within your circle of competence, you swing big. Most people feel the need to always be doing something in the market. Buffett's wisdom lies in knowing that sometimes the most profitable action is to do nothing at all. So how do these principles play out in the real world? Hagstrom provides some classic examples. Let's look at Buffett's investment in the Coca-Cola company back in the late 1980s. After the market crash of 1987, many investors were panicking, but Buffett saw an opportunity. First, he looked at Coca-Cola as a business. Did he understand it? Absolutely. It was a simple product with a powerful global brand. It was a business he could analyze and feel confident about its future. This was clearly within his circle of competence. Next, he assessed its long-term prospects. Coca-Cola had what Buffett calls a durable competitive advantage, or an economic moat. Think of a castle with a wide moat around it, protecting it from invaders. Coca-Cola's moat was its brand recognition, one of the strongest in the world. No competitor could easily replicate that. This meant the company could reliably generate profits for years to come. Then came the margin of safety. After the '87 crash, the stock was trading at a price that Buffett calculated was well below its intrinsic value. He saw a world-class business on sale, while others were selling out of fear. He was buying with conviction. And finally, he was patient. He didn't just buy a little. He invested over $1 billion, making it one of his largest positions. He was swinging for the fences on this fat pitch. And what happened? The investment became one of the most successful in history, making Berkshire Hathaway billions of dollars over the decades. He didn't buy Coca-Cola to sell it next year. He bought it to hold it, treating it like he owned a piece of the business, which, of course, he did. This story perfectly illustrates how all four principles work together. Understand the business, confirm its durable advantage, buy it at a great price, and then have the patience to hold on. So, how can we start applying these powerful ideas to our own lives, starting today? It might seem daunting, but it's more accessible than you think. Here are a few actionable takeaways. First, start defining your own circle of competence. Take out a piece of paper or open a new note on your phone. Write down the industries or types of businesses you genuinely understand. What do you do for a living? What are your hobbies? What do you read about for fun? Be honest with yourself. This isn't about what sounds impressive. It's about what you truly know. This list is now your investment hunting ground. Second, practice thinking like a business analyst. Pick a company from your list, one you use or admire. Don't look at its stock price. Instead, spend 30 minutes trying to answer 3 questions. How does this company make money? Who are its main competitors? And what, if anything, would stop a new competitor from stealing all its customers tomorrow? This exercise trains your mind to see the business behind the stock ticker. Third, embrace patience. Make a personal rule that you won't buy any investment on impulse. Keep by yourself a cooling off period of at least 72 hours. Before making any decision, use that time to double-check your reasoning and ask yourself, am I buying this because it's a truly great business at a fair price, or am I just afraid of missing out? This simple habit can save you from countless emotional mistakes. Remember, the goal isn't to become the next Warren Buffett overnight. The goal is to become a more intelligent, more disciplined, and more successful investor by adopting his time-tested principles. So, to recap what we've learned from the Warren Buffett Way, treat stock buying as business ownership. Stay within your circle of competence. Always demand a margin of safety, and be patient enough to wait for the perfect opportunity. It's a philosophy that values long-term thinking over short-term speculation, and discipline over emotion. It's a method that has proven its worth for over half a century. I highly encourage you to pick up a copy of Robert Hagstrom's book to explore these ideas even further. Thank you so much for watching today. If you found this breakdown helpful, please hit that like button and consider subscribing for more content that helps you build a wealthier and wiser life. Let me know in the comments which of Buffett's principles resonates with you the most. See you in the next video.